Joining us now, Sandy Villere, partner and portfolio manager at Villere & Company. Sandy, welcome back. Good to have you with us. Have we skirted the recession?
Yeah, I mean, I think we are going to skirt this recession. I mean, I kind of see GDP ending the year 0.7% to 1.4%, and we sort of avoid it completely. I do think that inflation is going to be a little bit stubborn, and so you're not going to see the rate cuts as quickly as maybe the street thinks. And so when you go back to 2022 and you're looking forward to a lot of rate hikes, growth certainly sold off dramatically. And then in 2023, when rates came down, growth had an unbelievable year. I just don't think that I think that rates are going to be, lower not until the end of the year, which is going to cause large cap growth, which is quite overvalued, by the way, versus 20-year averages, et cetera, to really stall. And then the action is going to be more in these smaller cap cyclical value names that are very undervalued versus their 20-year average.
Mm-hmm. Did I hear you say that rates came down in 2023? That's not my recollection. I mean, at the end of the year, rates backed off a little bit, and as there was increasing sentiment that the Fed was going to cut rates, but the rates for most of 2023 were moving higher.
Well, when you look at the 10-year going from 5%, really crossing under 4%, and they sort of rolled over that way, and now on the 10-year, you're back up to say a 4.13 or so. So I think that rates are going to be, maybe under 4 as opposed to really, taking off from here. So kind of an interesting setup.
So looking at where things were in October, where they sit now, and the forecast for the rest of the year, you see rates coming down.
Right.
Small caps. Why small caps? Why value? And give us some names.
Yeah, I think with a little bit of growth coming and rates doing what they're going to do, I just think they're mispriced. When I look at things like, Atlas Energy, I think energy is going to do quite well. They're in the middle of building a 42-mile conveyor belt system in the Permian Basin and just mining and delivering sand, a very simple, high cash flow business that's I think, mispriced. And so I think that's one that's interesting. Pool Corp, the largest supplier of swimming pool products in the world, I think had trough earnings in 2023 and will certainly look better in 24 and beyond. And I think the consumer is a little bit more resilient. And then I look at Palomar Technology, which is another name that only trades at 15, 16 times earnings and growing quickly. That's kind of been left for dead by the rest of Wall Street as they chase the Magnificent Seven. And so I think that's also an opportunity to be in a name like that. That's again just been unfound, and hopefully people find it.
You say the trade in growth, and especially large cap tech, is crowded right now, and that you think you'd rather be in small cap or large cap value. I wonder, does that suggest that it's going to be a bad year for large cap tech and the Magnificent Seven, or just that the smaller caps are going to outperform them?
Yeah, I think it's going to be more of a stock picker's market. And I think a lot of those larger cap Magnificent Seven are just going to stall. I think that you could see a little bit of a pullback in the names depending on where rates go. But again, I think with inflation being a little bit more stubborn, you may not see those cuts as quickly as people think, making large cap tech sort of stall out. And then when people are digging through the rubble and looking for, other names, I think they're going to discover that small cap is quite reasonably priced, and money could be allocated towards those sectors.